Gold opened this morning at 5,137. By the time Asian markets handed off to London, it had climbed to 5,168. And right now, as U.S. trading gets underway, it's pushing toward the $5,185 level cited in the title of this video. That 0.9% move in a single session sounds orderly. It sounds like a normal reaction to news. Surprised, it isn't. Here's what actually happened overnight that most of the coverage you'll read today is going to miss entirely. President Trump posted on Truth Social that the U.S. military operation against Iran is running, in his words, well ahead of the initial 4 to 5 week timetable. He suggested sanctions waivers were coming and that the U.S. Navy would begin escorting tankers through the Strait of Hormuz. Curious, that statement hit currency desks at around 2 a.m. Eastern. The U.S. dollar index, the DXY, which had surged to 99.68 on Monday, its highest reading since November 2025, immediately pulled back below 99 this morning. And when the dollar flinched, gold moved. That is the surface story. Dollar down, gold up. That is what Bloomberg will tell you. That is not the real story. The real story is this. The DXY just spent 3 trading sessions near 99.7, while gold was simultaneously sitting above $5,100. That has never happened before in this cycle. Historically, when the dollar surges toward 99 and above, gold gets hammered. It doesn't just hold, it doesn't trade sideways, it falls hard. This time, gold barely moved on the dollar's strongest days, then snapped 0.9% higher the moment the dollar twitched downward. Something structural has changed in how gold is pricing itself against the dollar, and the data from the last 11 days tells you exactly what that something is. There are currently more than 127 million ounces of open interest in the front-month gold futures contract on the COMEX, the Commodity Exchange Inc., which is the world's primary venue for precious metals futures trading. Against that paper exposure, the registered gold inventory, the metal that is actually available for delivery, sits at a fraction of that figure. The ratio of paper claims to real metal in those vaults right now is not a minor concern. It is a structural pressure point, and something happened in the last 10 days that is going to force those paper numbers to face the physical reality behind them. By the end of this video, you'll understand exactly what that mechanism is, why it is different from anything that's happened in this market in the past 4 years, and what 3 specific verifiable events in the next 72 hours will tell you which direction this resolves. Let's start with what is actually happening in the Strait of Hormuz, because until you understand the energy side of this, the gold trade makes no sense. On February 28, 2026, the United States and Israel launched what is now being called Operation Epic Fury, a coordinated air campaign targeting Iran's nuclear infrastructure, ballistic missile program, and senior leadership. Supreme Leader Ali Khamenei was killed in the opening strikes. His son, Mojtaba Khamenei, was subsequently named as his successor, and Iran launched waves of retaliatory missile and drone strikes against Israel, U.S. military bases across the Gulf, and commercial shipping in and around the Strait of Hormuz. According to the Armed Conflict Location and Event Data Project, which has been tracking strike-by-strike data since day one, more than 90 attempted Iranian strikes against Israel occurred in just the first 5 days. The death toll inside Iran from U.S. and Israeli strikes has crossed 1,255 confirmed dead. 8 American service members have been killed. The human cost is significant and ongoing. The commodity market consequence of all this is that tanker transits through the Strait of Hormuz, which in normal times handles roughly 20% of the world's daily oil and LNG flow, fell from an average of 24 vessels per day to just 4 vessels on March 1st. 4. That number comes from Vortexa, the energy markets intelligence firm that tracks vessel movements in real time. By March 9th, more than 150 large tankers were anchored or drifting in the Gulf of Oman, unable to transit safely. Brent crude, which was trading near $72 per barrel before the conflict began, briefly reached 126 on March 9th before pulling back slightly on news of G7 coordination talks. That is an oil price move of more than 75% in 11 days. Here is where gold's situation becomes structurally distinct from what you might expect. When oil spikes that hard, it is traditionally negative for gold, and here's the precise mechanism. Higher oil means higher headline inflation, which raises fears of Fed tightening, which pushes yields up and the dollar up, which suppresses gold. That is the textbook sequence. It is what happened in the 1970s. It is what analysts have been warning about for weeks. And yet the DXY at 99.68, with oil at 115, with markets pricing in only one 25 basis point Fed cut for the rest of 2026, could only hold gold near $5,080 on Monday before it snapped back to $5,185 today. That is a market telling you something the textbook does not cover. According to CME Group's own monthly update published this week, February saw micro gold futures, these are the smaller 10-ounce contracts that retail and institutional participants use for precise positioning, achieve their 3rd highest average daily volume ever recorded at 572,978 contracts per day. Microsilver set its second highest average daily open interest on record during the same period. These are not speculative froth numbers. These are structural positioning numbers. Participants who intend to hold, not flip. And inside the physical market, the picture is even more telling. COMEX silver registered inventory, the metal physically available for delivery against those futures contracts, fell below 100 million ounces in February for the first time in the current cycle. Official depository data from February 11th confirmed a single-day withdrawal of 3,156,182 ounces from the registered category, bringing total registered silver to 98,138,005 ounces. That same day, more than 4.7 million ounces were pulled from the eligible category, the holding pool that feeds into registered supply. Two categories bleeding simultaneously in a single trading session. Meanwhile, data published by Investing.com's analysis desk noted that the March 2026 silver futures contract represented 528 million ounces of exposure against 113 million ounces of registered silver at the time of analysis. That is more than 4 times the deliverable supply concentrated in a single contract month. Now here's the piece that most mainstream coverage has completely ignored. The Shanghai Futures Exchange silver contract has been trading at a premium of $3 to $5 per ounce above COMEX equivalent prices for weeks. At its widest point, analysis published by CoinWeek noted that the Shanghai physical silver premium exceeded $10 over Western spot benchmarks. When arbitrage between major exchanges stops working, it does not mean the premium is wrong. It means the physical market in one region is running so tight that the normal mechanism for equalizing prices has broken down. Metal that should be flowing east to capture the premium simply cannot move quickly enough. The Shanghai market is telling you something that the COMEX screen price is not. And this is the piece that will surprise even a sophisticated viewer. While all of this physical tightness has been building, the World Gold Council published data showing that January 2026 central bank net gold purchases totaled just 5 tons. That is an 81% collapse from the prior 12-month average of 27 tons per month. The sharpest demand cliff in the central bank buying cycle since 2022. In a world where central banks have been absorbing gold at a structurally elevated pace for 3 years, suddenly they almost stopped in January. The question is why? One credible interpretation: they already have what they need, bought at lower prices throughout 2025. Another interpretation: the institutions that know the most about what is coming in the gold market chose January to pause. They did not sell. They paused. That distinction matters enormously, and we will come back to it. Now we need to talk about the hidden mechanism. The reason why today's move is not just a reaction to a Trump social media post. The conflict that began on February 28th did something that no geopolitical event in the last decade has done in quite this configuration. It simultaneously attacked 3 of gold's 5 primary pricing pillars at once. It hit oil, which triggered inflationary concern, which threatened yields and the dollar. That was the expected move. But it also hit the physical custody of metal. When the Strait of Hormuz closes and marine insurance premiums for the entire Gulf region surge, the logistics of moving physical bullion from eastern vaults to western delivery points does not just become more expensive. In some corridors, it temporarily breaks down. In early March, according to data cited by financial content provider Market Minute, spot gold in certain regional markets traded at a discount of up to $30 per ounce below the London benchmark, not because it was worth less, but because the cost and friction of physical delivery had become so elevated that buyers could not get the metal where they needed it. When the paper price and the physical delivery price diverge by $30 in opposite directions depending on geography, you are not watching a normal market. You are watching a market where the connective tissue between the paper world and the physical world is under acute stress. Why is this happening now and not during previous Middle East crises? The answer is threefold. First, COMEX registered inventories are at structurally lower levels than they were during, say, the 2019 Gulf tanker attacks, or even the early stages of the Russia-Ukraine conflict. The cushion is thinner. Second, the conflict is not a skirmish or a drone exchange. The House of Commons Library briefing published this week, drawing on UK parliamentary research, describes the operation as targeting Iran's nuclear and ballistic missile program with the stated objective of regime change. This is not a limited engagement. The structural uncertainty about its duration is not resolvable in 24 hours or 48 hours. Third, the dollar's reaction this time is different. The DXY surged on safe haven dollar buying, yes, but the Bloomberg Dollar Spot Index's 0.7% intraday surge on Monday partially reversed the same day on G7 reserve news. The dollar is now caught between 2 competing forces: safe haven buying driven by geopolitical fear and rate cut expectations that had already shifted the dollar structurally lower throughout 2025. The historical parallel that best illuminates today's structure is not the Hunt brothers' silver squeeze of 1980, though the paper-to-physical tension rhymes. It is the period of October to November 2008. In that window, gold spot prices fell sharply during the initial Lehman crash, not because gold's fundamental value declined, but because institutional investors sold their winning gold positions to cover catastrophic margin calls elsewhere. physical premiums surged. Premiums on gold coins and bars in the US and UK reached historic highs. The spot price and the price at which you could actually acquire physical metal diverged by hundreds of dollars. Then, in December 2008, when the margin call cycle had exhausted itself, gold began one of its most powerful, sustained rallies in modern history. Today, you have an analogous liquidity-driven confusion between what the screen says and what physical acquisition actually costs. The key difference from 2008, there is no Lehman-scale equity market collapse to create forced gold liquidation. The forced selling this time was from ETF investors unwinding profitable positions. GLD saw $2.91 billion in single-day outflows on March 4th, the largest since 2016. That selling is largely done. The physical premium is not. You can print contracts. You cannot print the refinery capacity, the insured sea route, or the vault space to close a $30 gap between what paper says gold costs and what physical gold actually demands in a stressed market. This is where the institutional side of this trade gets genuinely uncomfortable for those who have been running the short side. The legitimate counterargument has to be stated fairly because it is not without substance. The bearish case goes like this. Gold has already rallied nearly 50% in the 12 months ending March 2026. JP Morgan's year-end target of $6,300 raised in early February assumes continued conflict-driven safe haven demand, continued central bank buying, and continued ETF inflows. All three of those assumptions are now under pressure simultaneously. Central bank buying collapsed 81% in January. ETF flows reversed violently in early March, with GLD shedding 25 tons in a single week, the steepest weekly decline since 2022. And the conflict itself, perversely, creates the conditions that most damage gold in the near term: a stronger dollar through safe haven buying, higher nominal yields through oil-driven inflation fears, and forced liquidation of gold positions by institutions facing margin calls in other markets. CME's own data shows the Federal Reserve's current rate stands at 3.50% to 3.75%, with markets now pricing just one 25 basis point cut by September. That is less accommodative than gold priced in January or February. The counter-argument is not trivial. It is grounded in real data. What it is missing is the second-order effect, and it is visible in today's price action. Trump's statement this morning that the conflict is running ahead of schedule, combined with his signals about sanctions waivers and naval escorts through the Strait of Hormuz, caused the DXY to fall back below 99. That DXY move instantly reversed the primary bearish pressure on gold. The dollar is the most important short-term variable for gold pricing, and the dollar is now caught in a tug-of-war that will not resolve cleanly regardless of what happens in Iran. If the conflict ends quickly and oil falls back toward $80, inflation concerns ease, the Fed signals resumed cuts, the dollar weakens structurally, and gold's conventional macro tailwind returns. If the conflict persists beyond Trump's stated timetable, the oil premium stays embedded in global prices, inflation expectations rise, rate cut odds fall further, the DXY holds near 99, and gold continues its unusual behavior of refusing to fall even as the dollar strengthens. It is also worth stating honestly that markets can defy structural arguments for extended periods. The physical paper gap, the vault drain, the Shanghai premium, none of these obligates a specific near-term price outcome. The market is capable of holding paper prices at levels that do not reflect physical reality for longer than most analytical frameworks predict. This is not a prediction. It is a structural observation. Here are three specific, verifiable things to watch over the next 72 hours that will tell you which direction this resolves. The first is tonight's CME Group Daily Vault Report, published at approximately 6 p.m. Eastern Time. The specific number to track is registered gold inventory. If it continues to decline rather than stabilize, the paper-to-physical tension in the gold contract is tightening rather than easing. You can access this directly on the CME Group website under Delivery Reports. The second is Wednesday's U.S. Consumer Price Index release for February, which the Light Finance Analysis team has flagged as the key macro event of the week. The market is currently pricing just one Fed cut for the year. If the February CPI comes in above 3.5%, which is entirely plausible given the oil shock that was just beginning to filter through in February, the Fed's hands become more constrained, and the bearish pressure on gold from a rate hold environment intensifies. If it comes in softer, the cut timeline reopens and gold's structural case reasserts itself. The Bureau of Labor Statistics publishes CPI data at 8:30 a.m. Eastern on Wednesday. The third is the status of Strait of Hormuz tanker transits tomorrow and Wednesday. Vortexa publishes daily vessel transit counts. The baseline before the conflict was 24 transits per day. If that number begins recovering toward 10 or 15, the oil war premium starts unwinding, inflation fears ease, the dollar weakens, and gold's move today looks like the beginning of a sustained leg higher. If transits remain near 4, oil holds above $100, and the stagflationary trade remains dominant, expect continued volatility with gold range-bound between $5,080 and $5,200 until something breaks in one direction. What the last 11 days have actually revealed is something more important than any single price point. The gold market has spent 3 years being described as running ahead of its fundamentals. Too much, too fast, too disconnected from the data. What the Iran conflict has done is expose that the disconnection was real, but it was running in the opposite direction. The paper price was the one disconnected from physical reality. When the Strait of Hormuz closed and marine insurance premiums surged, the physical market revealed what it actually cost to move real metal in a world of real stress. That $30 discount from London benchmark in certain physical corridors was not a price anomaly. It was the market telling you what liquidity actually looks like when it is genuinely tested. Gold at $5,185 today is not primarily a reaction to a Trump post about Iran. It is a reaction to the DXY rolling over from 99.68. But the DXY is rolling over because Trump is signaling conflict resolution, which means oil eases, which means inflation fears cool, which means the original macro setup for gold, falling real yields, a structurally weaker dollar, continued institutional ETF accumulation, reasserts itself at a moment when physical inventory levels are thinner than they have been at any comparable gold price in recent history. The screen price today and the physical market's structural position are pointing in the same direction for the first time since the conflict began. Given that the COMEX registered gold inventory is declining at the same time that the paper-to-physical delivery friction has created regional price divergences of up to $30, here's the question I want you to think about and drop in the comments. Where do you think COMEX registered gold inventory is in millions of ounces by the end of this month? Put your number below. I'll pin the most precisely reasoned analysis I find. The February CPI data drops Wednesday at 8:30 a.m. Eastern. I'll have the full analysis up the night before market open. If you're not subscribed with notifications on, you will miss it, and Wednesday's number may be the most consequential CPI release for metals investors since the reopening inflation prints of 2021. Everything in this video is sourced from public data. CME Group, the Armed Conflict Location and Event Data Project, Vortex of Vessel Transit Data, House of Commons Library Parliamentary Research Briefings, Bloomberg Markets Reporting, World Gold Council Demand Statistics, and financial data from Light Finance, CoinWeek, and Trading Economics. Every source is linked in the description. I'm not a financial advisor, and nothing here is investment advice. These are data points and analytical frameworks, not instructions. Verify every number yourself. The links are there. Make your own decisions.